Hey, it's Mark Ferguson with Invest for More, and today I'm going to talk about interest rates and housing and some other things having to do with inflation and rates as well. So the gist of this video is, why aren't high rates dropping prices? And a lot of people have just assumed if you have high interest rates, prices will just go down. But they're only looking at the demand side, they're not looking at the supply side. And a lot of people aren't looking at history, because history has shown us over and over again what happens with high interest rates, especially in regards to housing. So it's not a simple thing where rates go up, prices come down. It just doesn't work that way. So I've done a lot of videos on this over the last few years about interest rates, housing, inventory, prices, crashes, all of that stuff. And not to toot my own horn, but most of what I've said is what happened. And it's not because I'm super smart or know everything. It's just because I looked at history and I listened to some other really smart people who I thought made sense. And some of the other stuff I've heard, it doesn't jive with history and what has happened before. So what are we talking about here? So let's go back to the housing crash and talk about housing inventory and what happened. So we'll say 2006 is what our date is right now. And maybe you had demand right here. It was 10 million housing units, 5 million housing units, 1 million housing units for sale. Now your supply over here was about 5 to 6 million too. So these were in balance in 2006. Maybe there was even a little bit more demand in that range, a little bit out of balance in that range. Prices were going up. The problem with 2006, which is completely different than what we have now, is this demand right here was fake. It was not almost all of it, but a lot of it was due to horrible loans, horrible lending, horrible loans. There were people buying 3 houses who shouldn't have bought 1. I was an agent. I was a broker during that time. I bought my first house in 2003. I was making like $40,000 a year, had no verifiable income, is all commissions, and I bought a $190,000 house with no tax return pretty much. I shouldn't have been able to buy that house. Now, I didn't lose it to foreclosure or anything, but it was crazy how easy it was to buy houses. It's the complete opposite now. But this fake demand kept prices going and kept prices up. And what happened is supply was very high as well because of building. Builders were going crazy. It was much easier to build back then. They were pumping up supply like crazy. There were 5-6 million houses for sale. And that's why you had this market that kind of kept going up. Ironically, it wasn't going up as fast as it has in the last few years. And a lot of people think the market went absolutely crazy in 2006 and 5. But prices actually went up much faster in the 70s and even in the 40s. So it wasn't completely out of whack as far as history goes. So then what happened? We'll erase some of this stuff here, and we'll go to 2008. That was a fun time. What we saw in 2008 was demand tanked. So demand went down to like here, but you still had supply up here. And what happened was the banks realized we really shouldn't have been lending all this money to these people, because they shouldn't have been buying homes. There were so many subprime loans, which basically mean your credit score is below 620. So many people with stated income, which means they didn't have to show taxes, just said, yeah, I made $50,000, sure. You don't need to see any of my taxes. I made that, really. And so they realized, wow, a lot of these people shouldn't have had loans. Then foreclosures started up. There was some arms, some fraud, things like that as well that just added on to the storm. And so demand was driven down here. And the problem was supply was still up here because all those houses were still being built. And then a bunch of these people here started going into foreclosure, and supply went up here. And you had this massive imbalance of supply and demand, which meant prices dropped. We had a crash, and real estate was not in a good way. So what's happening now, or what's happened since then? Well, we'll use my finger for this one. Around 2012, and again, I sold probably close to 1,000 foreclosures. I was a HUD broker, an REO broker. selling those foreclosures is what I did for many years. But around 2012, what you saw was demand. I don't know if it's quite there, but it was starting to pick back up again. People who had lost their home, had been a few years, they could buy homes again. Building just went off a cliff. Building went way, way down. Building basically stopped after 2008. For many years, it basically stopped. And the foreclosures were getting bought up. So there are fewer and fewer foreclosures. So in 2012, you started to see the supply and demand curve go back to what it looked like pre-crash, and prices started going up again because you had more people buying versus how many houses you had for sale. And this kind of continued in this fashion or so, in somewhat form, through 2016. And then what happened in kind of 2016 to 17 to 18, well, we've got a lot of lines here. Demand kept going up because a lot of those people, the economy is doing well, people who'd been foreclosure before, now they were buying, more and more people wanted to buy. And this is a real demand too, not a fake demand. And supply kept going down. It was not there wasn't a bunch of building to meet this increased demand. And COVID kind of, amplified this, but this was going on before COVID. This whole market imbalance thing wasn't brand new to that. It has been going on for years and years, because basically building looks like this. If you can see this chart. So here's pre-2008, here's 2008, it literally did that, and it slowly made its way back up almost to normal now, and then interest rates popped up, it's back down again. We'll talk about that in a little bit, but there was years and years and years and years of too few houses being built because builders were scared, they were scared of a crash. Building codes, developing codes all got stricter. Financing got much stricter because of the crash. And they just weren't building enough houses. So this kept getting more and more out of whack. And now we'll go to 2023. COVID happened. It made things really crazy and out of whack too. But basically, we'll go to COVID real quick. This is the COVID year. This is kind of what happened. Demand shot up through the roof. Was it a fake demand? Maybe, because you had stimulus money, a bunch of money being put into the economy. It's possible you could call that somewhat of a fake demand, but it wasn't like people couldn't afford their homes. They had the money to do it. They were getting good loans. It wasn't bad loans, and supply was down here, like way down. This is a huge difference because people also didn't want to sell during COVID because they're scared and worried and didn't know what's going on, and builders were scared. They stopped building as much. So a huge imbalance. Prices shot up like crazy. So you would think things would get balanced back into play after COVID, and they did somewhat. So, demand dropped back down a little bit after the stimulus was done. Supply was starting to get better. Like I said, new construction was going up, and some people say they're building a record amount of houses right now. That's not really true. What they mean is there's a record amount of all properties under construction. But right now it takes 2 to 3 times longer to build a house or an apartment building than it did 10 years ago. So those houses aren't being completed, they're just under construction. So there's way more houses under construction now than ever before, but it takes them 2 or 3 times longer to be built. So there's not really a record amount being built or completed, or a record amount being started. We still have a massive supply, and that's all properties. And if you look at single family homes, that is still below normal of what we've had the last 60 years for new builds. So anyway, now we're going to 2023. And we've got this demand up here. Lots of people still want to buy houses. And actually, sorry. Let's 2022. This is before the interest rate increase. Lots of demand. People still want to buy houses, but we're still out of whack, right? They're starting to build more. Inventories maybe creeping up just a touch. Demand's still strong. Interest rates are incredibly low, so there's lots of people who can buy houses. And then we've got inflation, right? Inflation kicks in. Inflation's 7-8%. The Fed says, oh, it's just transitionary. It doesn't matter. Don't worry. We're never going to raise rates. And then they say, oh, wait, never mind. We were wrong. Now we're going to raise rates the fastest in history. And so the Fed, Powell, has said he wants to make the housing market in balance. That's the idea of raising rates, is we'll balance out housing and make it more affordable, or at least stop the price increases. And what has interest rates done? Interest rates haven't balanced anything out. They've made it worse. So here's what happened. I'm going to leave this right here just for reference. This is 2022, and we'll get a different color for 2023, just to be fancy. Okay, interest rates shoot up to 6, 7, 8%. What's it do? It kills demand. Yes, demand has definitely decreased. We'll say demand is down here now. So you can see there's a pretty big difference in demand. Not as many people can buy houses. What did supply do? Supply is at record low levels right now. It decreased as well, just as much or maybe more than what demand did. Why? Because people don't want to sell their house. If you have a 2 or 3% interest rate, you don't want to sell. It's not smart. If you want to just move up a little bit, you want a little nicer house, nobody wants to move right now. They're going to pay more money for a smaller house because of interest rates, so they're not moving. What else happened? Building slowed down. Here's normal building curve over 60 years. For 7, 8 years, we had record low building. Building was almost maybe at normal for single family homes. They bumped interest rates up. It took a dive again on building starts because builders are scared. They don't know what's going to happen. If your goal is to kill demand, what builder is going to say, oh, they want to kill demand for buyers, I think I'll just build way more houses? No, they're going to stop building as many houses too. That same thing also holds true for almost any business as well. This idea that interest rates will just magically drop prices is ridiculous to me, because I own businesses. I own a liquor store, a mini mart, laundromat. If someone tells me, hey, we're going to kill your demand and lower it so not as many people will shop at your stores, what do you think I'm going to do? Am I going to buy more inventory or make more things and sell more of it because I think less people are going to shop there? No, I'm going to lower my supply. I'm going to decrease my supply. I might even raise my prices, because there's no way I'm going to make more stuff and lower my prices and lose money. That doesn't make any sense. I'm going to make fewer things and sell less of it. And this idea that rates will just lower prices that's another video, but we're not seeing it now. So anyway, what happened was supply went down. Supply went down. I talked about this a long time before rates went up. This is exactly what happened in the 70s and 80s when they did the exact same thing. This isn't something brand new that we couldn't have seen happening. The exact same thing happened in the 70s and 80s. The 70s was the fastest appreciating housing market in the last 100 years. Rates went from 5 to 10. In the 1970s. The 80s weren't as fast appreciating, but they still had a pretty good appreciation rate. Rates went from 10 to 18 for a while, then back down to 10. Incredibly high rates. They never lowered prices. There might have been a tiny bump in 1981 where prices dropped for 6 months and then kept going back up again. Kind of what we saw in 2023, just like a rate shock. We'll be like, oh my God, rates are crazy. And then prices dropped for a touch, then came back up again. One thing I want to touch on too, a lot of people talk about the Fred graph, St. Louis Fred, showing housing prices down. And you'll see a graph like this, and it shows a drop like that. It's really tricky. That graph is new houses. New house prices overall have gone down. Existing houses prices are year over year up again. So back to this. What do we have? We still have an imbalance. And it might be a bigger imbalance than we had before because supply is so low and people still want to buy houses. You can't just expense people out of buying houses because everybody has to have a place to live. It's not like where you're thinking, oh, should I buy a third car or another car? No, the one I've got is good. If you need a place to live, most people are looking to buy one house or rent one property. It's not like, oh, should I buy this house or just live on the street? No, they're going to buy the house or they're going to rent the house. They need that property. Maybe some people can move in with family or have a roommate, something like that. There might be some instances of that. But people are still going to buy houses. They're still going to rent properties. There's always going to be demand here, no matter what you do with rates. And that happened in the 80s too. 18% mortgage rates in the 80s. People still bought houses. prices still went up. And that's exactly what we're seeing here. So high rates are not going to drop prices, or maybe even, they might even make it worse. And the thing that's really frustrating, because this is just going to make this problem worse in the future, as we mentioned building and how it's catching up here, and then boom, it dropped when rates went down. Well, maybe it'll go back, maybe it'll stay down here. Who knows what it'll do with high rates. If rates had been lower, if we would have kept rates down low, building probably would have kept doing this, and this is normal. And we might have gotten to a point where we had enough houses for everybody. And then, I know I've got all kinds of stuff going on here, but maybe you've got supply up here, right? And sure, maybe rates drop down and your demand is up here, but you're closer to being in balance that way with lower rates. Lower rates would actually help balance things out more than higher rates, because you'd have more supply, more people selling, more building, not fewer buildings. And with lower building right now and less building right now, it's just going to make this problem worse and worse and worse. Because if we go to 2025 and they still have high rates, inventory is just going to go lower, and demand's still going to be up here because our population's still increasing. People still need to buy houses. It's just going to get worse and worse and worse. And then eventually they're going to have to lower rates. And the longer they keep them high, the worse it's going to be when all of a sudden you lower rates, and then demand spikes up here because all these people who couldn't buy or were waiting to buy are like, yes, let's go buy. And then you've got supply maybe increases a little bit because you've got some people on the sidelines, who are waiting to sell, who are now able to sell. But now you've got an even crazier discrepancy between demand and supply, because all these people were waiting to buy for low rates. Some people here were waiting to sell, but building stopped. You don't have enough houses built, and now there's a crazy imbalance all going towards supply. So really, in my opinion, the only way to really balance out the housing market, which a lot of people don't like my, hypothesis, is to have lower rates. You have to bump up supply. Let demand do what it's going to do. People are going to want houses. They're going to want to buy rentals, whether it's now, in 3 years, in 5 years. The longer rates are high, the more that pent-up demand is going to increase. But if you start building houses now, it will make the problem easier to deal with in the future, because you start building that supply right now. And that works with almost every single business. I don't know any business is out there saying, oh, I'm going to increase supply because interest rates are high and they're trying to drive down demand. No, all those businesses are trying to decrease supply and keep their costs down and drive down their supply. They're not expanding. They're not making supply chains better. They're not working to increase supply because they know they're trying to kill demand. Now, if you let demand do what it's going to do, you make it easier to expand, you make it easier to create more supply, then you have an imbalanced market. You have things closer to what they're supposed to be. Yes, there's ups and downs. Yes, sometimes you might have some more inflation than other times, but you're not creating this huge bottleneck that's just going to explode at some point in the future. I wanted to add something into this too, because I've been doing more research and learning more and more and more about the historic housing market, not just what's happening right now. FHA played a big part in building houses too, which a lot of people don't know. So FHA is the Federal Housing Administration. It was created in 1934 as part of the New Deal to try and help the economy after the Great Depression. And ironically, during the Great Depression, there was almost no building going on. Just like we saw after the Great Recession and the housing crash, building was record lows. Same thing happened during the Great Depression. There was almost no building, and there weren't enough houses for people. There's a massive shortage of housing because they stopped building. So what did FHA do back then? Did they raise interest rates and try and kill demand? No, demand was already killed, but they still had to house people. They still had to have options for people to buy houses. What did FHA do? So, as the Great Depression eased somewhat and the prospect of improved financial status for individual families increased, the National Housing Act of 1934 was passed to relieve unemployment and stimulate the release of private credit into the hands of banks and lending institutions for home repairs and construction. They did the opposite. They didn't raise rates. They made it easier to build and easier to repair your houses. They put money into the housing market. They didn't try and make it unaffordable. Now, The FHA's assumption of risk through its insurance programs made possible the amortization of mortgage loans with regular monthly payments in a secondary market for home mortgages, thus freeing up funds for home loans. In 1937, the Federal National Mortgage Association, Fannie Mae, was chartered by the FHA as a subsidiary of the RFC. These early measures stimulated housing construction, and the United States Housing Act of 1937 authorized loans to public housing agencies for lower rent public housing construction expenses. So again, they tried to make it easier for people to buy houses by creating basically the 30-year fixed loan and mortgage insurance and low down payment options, and allowed more and more people to buy. And because of that, they knew they needed more houses, right? And so they also did something else so they could create more housing. Okay, so now I can't find the page I had, but I copied all of this down because I was going to write some articles or do some data with it. So one of the most important ways that the FHA subsidized builders was through its mortgage insurance program. The FHA would insure mortgages up to 90% of the appraised value of the home. This meant that builders could build homes with less of their own money, and they could sell them to buyers with smaller down payments. The FHA also offered builders lower interest rates on mortgages, not higher. They lowered the interest rate. This made it less expensive for builders to borrow money to finance their construction projects. The FHA also offered longer repayment terms on mortgages, which gave builders more time to sell their homes and repay their loans. They made it easier on builders by making money cheaper and mortgages longer. The opposite is happening now. With rates going up, it's way harder on builders, and that's why building has decreased so much. In addition to its mortgage insurance program and lower interest rates, the FHA also offered builders other incentives such as reduced upfront costs. The FHA waived some of the upfront costs of building homes, such as the cost of land surveys and title insurance. Technical assistance. The FHA provided builders with technical assistance on how to design and build homes that met its standards. Marketing assistance. The FHA helped builders to market their homes to potential buyers. They helped them. That's what they did. If they wanted more houses and they wanted more inventory, FHA said, hey, let's help builders and make it easier on them. They didn't say, oh, let's raise rates and just assume they'll keep building, even though it makes it way harder and more difficult. And something else, this is from another page. I still have this one open. I should go here. This is from ilsos.gov, Illinois Secretary of State. That's what it is. And there's a letter about them having problems with housing back then, and so many people were in foreclosure, and they still needed more housing at the same time. Talk about a crazy problem they had after the Great Depression. It wasn't like now where we just have too little houses and people have money. Back then, they had too few houses and nobody had any money either. So it was way worse back then. But the Federal Housing Administration was established by Congress in 1934. Its purpose was to ensure mortgages take out to finance home repairs and new construction. Over 1934 to 1940, 22,300,000 home repair loans totaling $945 million were insured by the FHA. Over the same period, this agency insured 554,000 new home construction loans totaling $2,300 million. And that was almost 100 years ago, right? When the population was way, way, way smaller. Obviously, money has multiplied many, many times since then. And this is what they were doing to get money into housing, to get more affordable housing and more housing, which is what was needed. Now, the administration has said to make housing affordable, they want to help buyers, afford houses. They don't want to. There's nothing there to get people to build more houses. It's all to have people afford more houses. But if there's not enough houses and you make people, be able to buy more houses, that just makes the problem worse, more out of balance. And something else they've wanted to do is make building codes stricter. There was something like, hold on. I wanted to see how much money, it's hundreds of millions of dollars, the current administration has dedicated to making building codes stricter. And if you look at building codes across the country, the places with the most strict building codes have the highest prices. If it costs more to build, it's going to cost more to buy houses. And while they're saying, I try not to get political on here, but this is something directly related to real estate, they're saying that they want houses to be more affordable, but at the same time, when you modernize building codes, say you want them to be way stricter, making energy efficient homes, those guidelines be way more stricter, you're going to make houses way more expensive. That's just how it works. So I want to interject this too real quick. There's multiple studies. It's not just me making up this show. The cost to build, building codes, development, approvals, all have increased housing prices significantly. It's not because investors are buying. It's not just because there's too much money in the system. It's also because housing has gotten way harder to build. And this study from Harvard goes into it, just the abstract. Since 1950, housing prices have risen regularly by almost 2% per year. Between 1950 and 1970, this increase reflects rising quality and construction costs. Since 1970, this increase reflects the increasing difficulty of obtaining regulatory approval for building new homes. In this paper, we present a simple model for regulatory approval that suggests a number of explanations for this change, including changing judicial tastes, decreasing ability to bribe regulators, rising incomes, and greater taste for amenities, and improvements in the ability of homeowners to organize and influence local decisions. Our preliminary evidence suggests that there was a significant increase in the ability of local residents to block new projects and change of cities from urban growth machines to homeowners cooperatives. So really, this is saying it's your fault. The homeowners who blocked low-income housing, blocked new subdivisions, made it much, much harder to build and develop. And the places that are the hardest to build and develop have the highest prices. And this also is right in line with building codes have significantly increased prices as well. California has some of the strictest building codes in the country. And ironically, they have some of the most expensive real estate in the country. Same with New York. Same with Seattle. Same with many areas across the country. And people might say, well, yeah, they have earthquakes there. They've got flooding there, whatever. They have to have strong building codes. I'm not arguing that. I'm just saying that's a pretty accepted fact, given the number of papers and different conclusions that come from that, that building codes are a significant drive of housing prices. Yeah, you can see here, this is from the White House, their comprehensive review, federal funding and financing of building construction. They want to get everything up to modern building codes, which are kind of crazy in some areas. In some areas of Colorado, you are required to have a sprinkler system for a house, an indoor fire sprinkler system. That's part of the Marshall Burn Fire, why it's been so hard for them to rebuild houses, because of those codes, which they actually had to lessen to allow people to rebuild houses again. That might be another video. But law funding for the Department of Energy to support implementation of updated building energy codes and create good quality jobs. Provide incentives and support for communities to adopt current building codes and standards. Lead by example across the federal building portfolio by seizing opportunities to advance above code resilience and energy efficiency standards in new projects. So basically, they want to make housing more expensive. So they want housing to be more expensive. You raise interest rates, so it's harder for people to build. You kill demand to counteract those things, but people still need a place to live. So for some reason, none of it has seemed to be working so far. All right, that's all I've got. Let me know what you think. That's why high rates haven't caused housing prices to go down. And no matter how high you push rates, they're probably not going to cause prices to go down either. It's probably just going to make the future worse because there'll be so little building.